Are you ready to make your money work for you? Let's start at the beginning. Understanding various types of investments is key to creating a diversified and resilient investment portfolio. Let's kick things off by talking about stocks. When you buy a stock, you're essentially purchasing a piece of a company. This makes you a shareholder and it gives you the right to a portion of the company's earnings and assets. Stocks are considered high-risk investments, but they also offer high potential returns. However, the value of stocks can fluctuate wildly, so they're best suited for long-term investments. Next on the list, we have bonds. Bonds are loans that investors make to entities like governments or corporations. When you buy a bond, you're lending your money to the issuer in return for periodic interest payments and the return of the principal amount at the bond's maturity date. Bonds are generally considered lower risk than stocks, but their returns are also typically lower. Real estate is another popular type of investment. This involves purchasing property with the expectation that it will increase in value over time. The returns from real estate investments can come from rental income or from the sale of the property. However, real estate can be an expensive and time-consuming investment, and it's not as fluid as stocks or bonds. Lastly, we have cryptocurrencies. These are digital or virtual currencies that use cryptography for security. The most famous cryptocurrency is Bitcoin, but there are thousands of others out there. Cryptocurrencies are extremely volatile, and investing in them can be risky. However, they also offer the potential for very high returns. From stocks and bonds to real estate and cryptocurrencies, each investment avenue comes with its own set of risks and rewards. It's important to understand these risks and rewards so you can make informed decisions about where to put your money. And remember, successful investing is not about putting all your eggs in one basket. It's about spreading your investments across different types of assets to create a diversified and resilient portfolio. Now we're diving into the heart of the matter: investment strategies. There's a whole world of strategies out there, each with its own unique philosophy and approach. Let's explore a few of the most popular ones. First off, we have value investing. This strategy is all about hunting for undiscovered gems. Value investors are like financial detectives looking for stocks that are undervalued by the market. They believe that the market overreacts to good and bad news, causing stock price movements that do not correspond with a company's long-term fundamentals. The key here is patience, as it can take time for the true value of these stocks to be recognized by the market. Next up, growth investing. Unlike value investors, growth investors are interested in companies that display strong signs of above-average growth, even if the stock appears expensive in terms of metrics such as price-to-earnings or price-to-book ratios. They bet on the company's potential, hoping that rapid growth will lead to significant returns. Then we have dividend investing. This strategy involves investing in companies that regularly pay dividends. Dividend investors enjoy a steady income stream in addition to any potential capital gains. This can be particularly appealing for those planning for retirement or wanting to balance out more speculative investments. Let's not forget about dollar cost averaging. This strategy involves regularly investing a fixed amount of money in a particular investment, regardless of the price. Over time, this can reduce the impact of volatility on the overall purchase. The purchases occur automatically regardless of the asset's price. More shares are purchased when prices are low, and fewer shares are bought when prices are high. Lastly, we have the buy and hold strategy. This strategy involves buying an investment and holding on to it for a long period of time, regardless of fluctuations in the market. It's based on the assumption that prices will increase over the long term, despite short-term volatility. Choosing the right investment strategy depends on your financial goals, risk tolerance, and time horizon. Remember, there's no one-size-fits-all approach to investing. It's about finding the strategy that fits you and your financial journey. Investing always involves an element of risk. Let's delve into risk management strategies. When you dip your toes into the pool of investments, it's crucial to know that risks and returns are two sides of the same coin. But this doesn't mean you should shy away from risks. Instead, it's about understanding and managing them effectively. So how do you assess risk? Well, it's a combination of quantitative analysis, such as studying the volatility and performance of an investment, and qualitative analysis, like evaluating the management and competitive position of a company. This holistic assessment helps you understand the potential upsides and downsides of an investment. Now, once you've assessed the risk, the next step is to mitigate it. And one of the most effective ways to do that is through diversification. Think of it as not putting all your eggs in one basket. Diversifying your investments across various asset classes, sectors, and regions can help spread the risk and potentially increase your chances of earning a return. But diversification isn't just about spreading your investments thin. It's about creating a balanced portfolio that aligns with your financial goals and risk tolerance. For instance, if you're a risk-averse investor, you might want to have a higher proportion of bonds in your portfolio. On the other hand, if you're willing to take on more risk for potentially higher returns, you might lean more towards stocks. Along with diversification, another critical risk management strategy is regular portfolio rebalancing. This involves adjusting your portfolio periodically to maintain your desired balance of risk and return. For example, if one of your investments has performed exceptionally well, it might now make up a larger portion of your portfolio, thereby increasing your risk. Rebalancing helps you realign your portfolio with your original investment strategy. Lastly, remember that risk management isn't a one-time activity. It's an ongoing process that requires regular review and adjustment in response to evolving market conditions and personal circumstances. Understanding how to assess and mitigate risks is crucial for long-term success in the world of investing. If you're new to investing, don't worry, we've got you covered. The world of finances may seem intimidating at first, but with the right guidance, you'll be navigating it like a pro. Here are a few practical tips to help you hit the ground running. Firstly, set realistic financial goals. What are you investing for? A dream vacation, retirement, a new house? Having clear objectives will keep you focused on the journey ahead. Secondly, consider starting with index funds. These are a great way to dip your toes into the investing pool. They offer broad market exposure and are generally considered safer than individual stocks. Lastly, stay informed about market trends. Knowledge is power in the investment world. Keep an eye on financial news and understand how global events can impact your investments. These tips will help you kickstart your investment journey with confidence. And there you have it, Money Minds, a comprehensive guide to investing strategies. We've journeyed together through the whys and hows of investing, explored the diverse landscape of investment types, and delved into the intricate world of investment strategies. We've also touched on the critical aspect of risk management in investing, and sprinkled in some handy tips for those just embarking on this journey. Remember, the world of investing isn't a sprint, it's a marathon. It calls for informed decisions, unwavering discipline, and the agility to adapt to ever-changing market conditions. If this video has equipped you with some valuable insights, do show us some love. Hit that like button and subscribe for more financial wisdom. And don't be a stranger. Share your thoughts, experiences, or questions in the comments section. Thanks for joining me today. I'll see you in the next video.